Hey everyone, welcome back to another episode of the Integrating Investor. I am Seth Levine of the Integrating Investor website. Thank you so much for joining us again. I'm so excited to be here again with all of you to finish up our interview with Corey Hoffstein. We started last week with part one. We're going to finish up here with part two. It's just another fascinating deep dive. I mean, if you liked last week's episode, you are going to absolutely love this week's. Here in this week, we'll get into a little bit more on timing luck, and you'll see what that means in a second. We'll also touch upon crypto, which seems to be unavoidable these days. And we'll get into some fun personal questions as well. We'll finally answer what the gingerbread house is all about that I teased about in part one. So stick with us. And as always, please like and share this episode to help get the word out. Follow me on Twitter or Instagram, sign up for my monthly emails and all that good stuff. And again, please use the super chat function here to ask Corey any questions that you may have, because while it's recorded, Corey, like everyone else, has graciously agreed to answer any questions that you may have. You have any, again, feel free to reach out to me at info@integratinginvestor.com. That's info@integratinginvestor.com with any questions you may have, show topic ideas, or interview guests. I love to hear from everyone. So without further ado, I will do everyone's favorite part here and share the disclaimer slide. Again, these are just personal comments, personal opinions. These are not investment advice that me and Corey and I are talking about. They're not, recommendations to buy or sell anything. There may be conflicts of interest here. I don't know. Do your own investment work, please, and be responsible for your own capital. So with that out of the way, without further ado, we will get into part two of my interview with Corey Hoffstein. So Corey, we were talking about the unintended consequences, the unintended bets that people make with their investment portfolios in our last episode. I was wondering if you could expand upon that and kind of see where else, you see this type of behavior kind of manifesting.
Yeah, so maybe I can start with an example, because sometimes I think it's way easier to go with an example. So in the world of tactical asset allocation, one of the most popular papers is a paper by a friend of mine, Meb Faber, who wrote his paper. I think it was 2006 originally, published in 2007. And I believe the paper was called Quantitative Tactical Asset Allocation. And it was this idea of using a really simple 10-month moving average as an indicator when to get in and out of different asset classes. So it was tested on equities, commodities, bonds. And what he found was that while many of these had a slight reduction in return, there was a dramatic reduction in risk. And so he was proposing that you could build a portfolio using this very simple 10-month moving average system, where at the end of each month, you looked at the prior 10-month moving average. If price was above, you would stay in the asset class. If price was below, you would sell. And it has proven to be incredibly robust. And a lot of people would say it's so simple, that's what makes it robust. There's no crazy bells and whistles. It's not overfit. You're not changing the model on different asset classes. It's the same model across all asset classes. There's a couple of questions that I ask, though. One of the questions that's worth asking is there anything special about the 10-month moving average? Why not the 9-month? Right. Why not the 11-month?
Why not the 9 3/8 month?
Exactly. And so what happens is, if you ask that question and you test these counterfactuals, what we could have chosen instead, you end up finding a massive dispersion in results. And if you go back in time and you figure out where that dispersion comes from, it's because there are periods of time where price was literally half a percent away from switching off at the end of the month, but the 10-month moving average just happened to be in the right place that it stayed on, versus the 9-month you would have gone out. And there's a couple of happenstance, right? It's not that the 10-month moving average was magic. You just got lucky, right? And so the question becomes, we're looking at this long-term performance of the 10-month moving average, but when we look at an 11-month or a 9-month and we have this large dispersion in results, I would argue that your more likely result going forward with the 10-month moving average is not your prior results with the 10-month moving average, but it's more going to be like the median result of these other counterfactual similar things where you're actually ultimately averaging out the luck.
Now, would you say that, would you kind of characterize that as a mean reversion in your return in a way?
It's not necessarily mean reversion, because getting unlucky doesn't imply you're going to get lucky going forward.
Right. I see.
Right? You could just get unlucky once over your investment life cycle, and that can be enough. And again, I don't want to talk about changing market structure and all that sort of stuff. Just sort of like generically, we're using one signal and we think it's robust because it's simple, when in reality, it's incredibly fragile, in my opinion, because it's just one signal. Now, that doesn't mean we should add more bells and whistles. What I would argue is the same way we diversify our holdings, we should diversify our signal.
Right.
So instead of using a 10-month moving average, well, let's also use an 11. Let's also use a 9. Let's also use a price, not just price minus moving average crossover. Let's use a dual moving average crossover, or a total return signal, or different ways of measuring trend. And so instead of getting a light switch, a binary on or off signal, we end up turning it into a dimmer. And that dimmer is much more robust. So that's one, to me, like diversification actually has 3 axes.
Okay.
What we invest in, how we make those investment decisions, and then the third is when we make those investment decisions. So we just talked about the how, right? We have this signal. It's really simple. Turns out you can get really lucky, really unlucky. So just to really like drive that home, March 2020, end of February 2020, the 10-month moving average got you out of the market. Meb Faber's signal worked perfectly. Another really popular tactical system among do-it-yourself investors is called GEM. It's by a gentleman named Gary Antonacci, and it works on 12-month prior returns. And at the end of every month, you look at the 12-month prior returns as to whether you should stay in or out. Gary's signal said stay in. Meb said get out. Gary said stay in. In theory, over the long run, they're both long-term moving average trend following systems, but gave exact opposite signals. So Gary rode the market all the way down. Meb got you out. And it's not because the 10-month is better than the 12-month total return. It's just happenstance and luck.
Yeah, that's interesting. So I guess, so what was your kind of solution to this? Is it, I mean, maybe I'll lead you there a little bit, but it seems like you have this almost concentration in time, and let's call it maybe time happenstance, just to keep it with the parlance. I guess, what have you done about that?
Yeah. So it's really more a concentration in concentration in signal. So what my argument would be is the same way you wouldn't invest in one stock, you wouldn't invest with one signal. So you need to diversify your signals. So if I don't think that the 10-month moving average is special or magical any more than the 12-month total return is, then really what I should do is use all those signals and come up with an average signal that gives me an average position.
Yeah.
And I would average all those together. The other, and you just mentioned this sort of like time aspect as well. That's another big one.
Yeah.
So think about this. So far, we've only talked about these systems that rebalance at the end of the month. But what is magical about the end of the month?
Right. Or the end of day.
How would the results differ if I said, we're actually going to do this exact middle of the month? And you would say, well, it can't be that different. Well, once again, you'd be very surprised if you actually tested this. You end up with massively different results.
Interesting.
And it's not about some magic seasonality. Again, it's just about the luck of when did market events unfold relative to this very arbitrary calendar we've decided to impose upon them.
This is fascinating. Now, in our last episode, part one, you had mentioned that you were thinking about this concept of almost market time, information time, right? We were talking about how there are certain periods of times where the information that impacts prices is it's non-linear, in a sense that there's certain periods of time where you get a lot of information that is important, and other periods of time where you don't, and it's totally non-linear. There's an information scale of price that's totally different than time. Now, I've seen in some of your research, and obviously at least from this conversation, that time, kind of the timing luck, if you will, factors into our investment. And you are kind of suggesting that taking an ensemble view of time could be beneficial. Do you see that relating to? Do you see those two things relating? In other words, like using an ensemble of time as a way to correct for an unknown kind of information importance scale?
So let me, yeah, absolutely. I'm right there with you. So I'm going to talk about two examples, because when you talk about what's an ensemble of time, like this is where it's like, okay, we're talking, I don't know, like Doctor Strange. It's getting out there. So we don't talk about this in public markets because they're so continuous. So let's go to private markets really quickly.
Okay.
PE. If I said to you, I'm going to give you $1 million that I want you to deploy in private equity. Most people, when they think about the problem, would go, well, I don't want to deploy it all right now because it constrains me in two ways. One, what are the companies that have come to market recently? Like, what are the opportunities that are present to me? And then two, where are we in the market cycle? If I happen to invest everything, all $1 million today, it might be maybe just a cohort of companies wasn't very attractive and some new super innovative company comes out in 6 months. And then B, what if this is the top of the market cycle and I'm getting peak valuations? So what most people do with private equity is they split it up into vintages. They take some of their money and they invest it this year. Then they take some of their money and they invest it next year and the next year. And they have these vintages that eventually roll. So 7 months when you start 7 years, excuse me, when you start realizing your returns, you take that money and you reinvest it in your new vintage, and you're constantly rolling these vintages. And in doing so, you're averaging out that timing luck, right? So that's how you create time diversification. Well, let's tie that now back to like that information changes really quickly with a practical example in public markets. ETFs that have come to market that are tracking these like factor indices typically rebalance quarterly or semi-annually. So there's a really popular one from BlackRock iShares. That's their momentum strategy. And it rebalances twice a year in May and November. And what it's going to do, I mean, without going into the nitty gritty, it's basically going to say which stocks have gone up the most over the last 12 months. Let's overweight those stocks and avoid the stocks that have gone down the most over the last 12 months. So rewind to last year. COVID happens. Tech stocks take off, old economy, debt-laden, small cap stuff craters. And when they rebalance in May, they rebalance very heavily into high profitability, strong balance sheet, quality names, mostly mega cap tech. Because those are the ones that we're seeing like they can survive COVID. Right. And they stick with those. And then all of a sudden we get the vaccine news in, when was that? October, November?
Yeah, I don't even remember, but yeah.
And we get a complete,
whatever it was, yeah.
Complete market reversal. But even though value in small caps started to take off, when that ETF rebalanced in November, they had not rallied enough to stay in the portfolio or to make their way into the portfolio. So that momentum ETF, just because it rebalanced in November, ended up sticking with all the mega cap tech names.
Right.
And so while mega cap tech lagged and small value took off, the momentum trade fell behind the reopening trade.
Right.
Okay, now fast forward to May this year, the reopening trade has actually peaked. The inflation fear has peaked, and it's now rebalancing in May into all of these small cap value names that have already run for the last 7 months.
Right.
And it's ditching all the tech names. Now, all of that is simply because it happened to get unlucky in the timing of when it rebalanced. I would argue, well, wouldn't it be better off if it more continuously rebalanced?
Right.
In fact, mentally, the way we can think about this is let's create 6 different momentum ETFs, right? We have this May and November variation, but what if we also had a June and December and a July and January, and we created the different pairs, right? That are all 6 months apart. And then I put my money equally into all 6 of those ETFs. I've effectively eliminated that timing luck. And if I look at my money on average, it's sort of doing that same PE tranched thing. 1/6 of my money is getting rebalanced every month.
Mm.
And so in that way, we're avoiding this timing luck that can be create huge dispersion in return. So I know I just sort of rambled on a while, but so let me put like one bow on it. People really don't think this makes a big difference, but in something as simple as like a 60-40 portfolio of like when you rebalance in the year, it can cause hundreds to thousands of basis points of performance dispersion just based on when did you rebalance. When you start talking about a momentum portfolio, you know, comparing against the counterfactuals of when else could you have rebalanced, there were many years in the last 20 that would have caused, you know, 2,000 basis points of performance dispersion between, you know, what you could have versus what you got. And it's all just based on this rebalance timing luck. So no one talks about this. I mentioned to you, I'm Don Quixote tilting at windmills on this topic. It'll go on my grave, but I think it's one of the most overlooked sources of risk in a portfolio.
That's absolutely fascinating. And again, this goes again to trying to look at what bets are we making without even knowing it. And yeah, this timing issue is definitely there. And I've seen that you've written on it. You obviously have some, you've done research into it. I mean, what have you found? I mean, what happens when you diversify your timing? Do you find that the returns kind of disappear? Like, I almost wonder if a lot of the returns we get are, and we think are maybe alpha, or maybe timing. So I'm curious, kind of what you found by researching this.
So what I've found is that there are definitely cases where managers who look like they've produced alpha just got lucky. Mm-hmm. So one of the most famous examples is actually Research Affiliates. So if you go back to 2008, they have what's called the immaculate rebalance. And you can actually Google that term and it'll come up with them. They were rebalancing their fundamental index portfolio, which is they're buying high quality value stocks, and they were rebalancing once a year. And I think they rebalanced in June. I might be wrong on that, but rebalanced once a year. And it just happened to be perfectly timed for a value stock reversal. And they added hundreds to thousands of basis points on the index. If you changed when in the year that portfolio rebalanced using the exact same stock selection and weighting methodology, but you changed it, I think it was to September, they would have underperformed the index. So what does that tell you, right? That they went from thousands of basis points of outperformance to underperformance simply based on when they arbitrarily had scheduled their rebalance. Is there something magical about June?
Right. Either they're very good at marking timing, which is a skill, and June is something special, or there is just a luck involvement in there.
So
or maybe third could be a market structure that they're aware of or they're unaware of. Yeah.
So post this, they actually adopted the approach that I recommend, which is this tranching methodology, where they rebalance part of their portfolio more continuously every quarter. And because they recognized how lucky they got and how unlucky they could get. But that it's not like you erase that from their track record. If you look at the track record of their performance, they have this immaculate rebalance that looks like phenomenal alpha, but it's not alpha. That's right. They got lucky. It's an uncompensated risk in the portfolio that you're taking, and they just happen to get the good side of it. But imagine if it had gone the other way, would they be the company they are today?
Yeah, that's a fascinating question. If you don't mind, I'm going to change gears here and or switch gears here and maybe go down another wormhole that may be a little bit dangerous. But I've noticed, on one of your podcasts, you started to dive a lot, and even on Twitter, you've dove pretty deep into crypto.
Oh yeah.
I have some pretty well-formed views on crypto now, and they've changed a lot over the years for me. Kind of curious, like what you make of it, and your thoughts on it. Obviously, not investment advice here, but anything along those.
Yeah, I have a lot of very poorly formed views on crypto.
Okay, that's par for the course, I think.
Yeah, let me start with this by saying two things. First, we mentioned in the prior episode that I think as we get older, our accumulated wisdom helps us screen out a lot of things that we say, this looks and smells like something I've seen before, I'm going to pass on it. We go from like that pure exploration mindset to this exploitation mindset. We know things, and so we can hone in faster. But I think it also means we tend to become more calcified in our views. Mm-hmm. And so I have very proactively recognized in myself that I'm starting to do that, and I don't want to. And so I'm encouraging myself to play. And I don't mean that in like the kid sense, but I'm encouraging myself to have the lateral freedom to say, I'm going to go do some stuff that I actually think is pretty stupid, but I need to learn.
Right.
So I'm trading NFTs. I'm getting involved in DeFi. I'm trying to run arbitrage on different things in the ecosystem because I want to see how it is from an actual experience perspective, not just from an outside looking in judgment. Now, I will say it's eaten up a lot of content for me in terms of like, Pirates of Finance. We talk about it a bunch. On Twitter, I talk about a bunch. And I joked the other day on Twitter that I was going to go back to like talking regular finance stuff. And I looked forward to updating everyone on my call with my custodian about new wire instructions. And the joke there is like, yes, I am talking about crypto and NFTs a lot, but only because it's a lot more entertaining than the reality of managing funds, which day to day, is pretty boring, and it should be boring. And like a lot of the research I can't share all the time.
Right.
So crypto is one of those things that I think is fun and engaging. I'm not doing this full time. I think people get the sense I've like really lost my mind. This is like a little pre-market, a little post-market, just trying to keep my finger on the pulse. Long-winded intro. I'll do a quick little outro. So what are my thoughts? My thoughts are, I've never read in history about any industry that has had so much brain power go towards it and have nothing come out of it. So I have no idea what inning we're in, but I know so many brilliant people that are putting their efforts towards this that I might not see the full picture yet, but I don't think many people ever can. I think we see the full picture in the hindsight of history. I think the reality is when you live change, it's easy to be skeptical about change. So I'm sitting here going, I think if there is change, it's probably, I don't know whether it's marginal, I don't know whether it's large, but I want to have my finger on the pulse. I want to own a little bit of it. I'm not diving headfirst fully into it, but I don't think this is going away necessarily. Are there huge regulatory risks and tax risks and all those other things? Absolutely. Do I think a lot of this is being used illegally? Absolutely. But that said, I think it has the possibility to impact our lives in a lot of varying ways in which I'm not smart enough to predict. And so I just want to be passively trying to stay on top of it.
Yeah, that's a real interesting way of looking at it. I mean, people probably know how I've evolved my thoughts a lot. Very early on, I'm very much laissez-faire capitalist. I'm like a very much individualist. Like early on, I mean, I'm talking like 2011, 2012. I was drawn into the world. I just played around a little bit. Got burned. Kind of came out of it. But I was like drawn to that I'll call it like the kind of political, the hands, the free as in like unregulated kind of money aspects that I think is very promising. But I've completely shifted my views to, I call it even a momentum view now. And I think you can even use what you just brought up to fill that. Like there is an intellectual momentum, not just a price momentum, but you just look at the intellectual horsepower that's involved in the industry. And I'm kind of with you. It's hard to be too skeptical about it, just
Yeah.
because if you're like if you believe in like human ingenuity, it's just too it's too large a signal for me to overlook. And I've had a hard time reconciling that over the years. And really what I finally have the light bulb finally went on with me, it all comes down to position size, right? How much risk do I want to allocate to this idea? And it doesn't have to be all or nothing. So yeah, it's fascinating kind of how
I love that phrase you just used, intellectual momentum. I love that.
Thank you. Yeah,
I think that's spot on. And like, I think that if you were to ask me if I could steal that from you and rewind this 5 minutes ago and you say, Corey, what's your view? I would say, well, it's intellectual momentum structurally. Like long term, that's like, I have a lot of buy and hold crypto. Now, when I say a lot, I mean, it's less than 3% of my overall investment portfolio. So position sizing is important, but like, it's just buy and hold. To me, intellectual momentum kind of diversified across what I think the major projects are. And then there is like a bunch of other like frothy crap, NFT type plays just to stay involved. But I think there's also this other aspect to me that is just the pure price momentum. That is, there's a ton of trapped money in crypto. Retail investors, institutions, VCs are pouring money in. That money's being used as the backbone for the creation of new tokens. Those tokens are then being used as collateral to create other new tokens. And you get sort of this fractional reserve system on steroids, but none of it ever really burns off because it's not coming out of the system. It's not being spent. There's no real buybacks happening. And so to me, there is a bit of like, I don't want to say Ponzi bubblenomics going on, but I think this can both be simultaneously a long-term, massively impactful industry and still think that the majority of this is going to zero.
Yeah, it's really interesting. Like I see a lot, what I see, and I'm just around the edges. Like I'm not a crypto expert. Do not take, and no one take these comments as I am one. But it almost seems like we're recreating the fractional reserve banking system in crypto, like that whole ecosystem, right? And now probably better because you're doing it without a lot of the regulations, which I personally think create a lot of the bubblenomics, to quote you, kind of in the ecosystem. But there is just a lot of, but what banking is, and I've covered this in a couple episodes, is banking is leverage. So you're building up a ton of leverage. And right now, all that flow, if you will, kind of the money flow has been into crypto. So it's almost been and the momentum, both on intellectual and capital perspective, has all been positively into the system. I almost see that as like creating more and more leverage. And I'm a little just, I don't want to say worried, but I'm not involved in crypto, full disclosure, at this period of time, at the point of this recording anymore. But I'm curious to see what a deleveraging would look like. I suspect it's got to be vicious, but
yeah, I mean, we do see at the exchange level very vicious deleveraging cycles, right? There's so much leverage that can be, prior to this year, people could have 100 times leverage on their positions.
Right. And that's just on a position. That's not like a position on a position, on a pyramiding of.
Yeah. So on the centralized exchanges, they have automated liquidation schemes. The reason crypto has these violent sell-offs is because of auto liquidations.
Yeah.
And you might say, well, look, there's no backstop the way there are in our markets, right? These markets aren't shutting down. There's no circuit breakers. There's no central bank. And despite the violent liquidations, they keep chugging, right? So it is this interesting, like, we can see how two different markets operate in parallel. And maybe you, even though there's our violent liquidations, you prefer the freedom of this one. What has attracted me to crypto has been in getting my hands dirty, seeing the speed at which the financial industry is being replicated. The DeFi system, decentralized finance system, has taken and is taking every part of the world of finance and replicating it and making it composable into these money Legos. And yeah, a lot of it is going to fall apart and is poorly designed. But when you go, wow, I can have some long Bitcoin that I post as collateral and borrow, 30%, stable coins against to go buy something else. And there's no middleman. It's all a smart contract and it's approved within 20 seconds. And it's all like, you go, wow, why do we need banks in the way all the time? Like, imagine getting a mortgage that way.
Right. Yeah, it's fascinating. It's a fascinating space. It's a space that I dip in and out of over the years. And yeah, I guess we'll just see what what comes of it.
It'll be amazing in 10 years to look back and say, what inning were we in? Right. It feels like it's been a long time that crypto's been around, and you say, well, crypto hasn't done anything yet. Like I think the entire crypto ecosystem could go away and nothing would change in the world. Right.
Yeah,
it's not right. So it has to be early innings. And yet on the other hand, you look at the price of Bitcoin or Ethereum and you go, those are some pretty richly valued assets in aggregate. If you look at their sort of total circulating market cap,
Bitcoin's a teenager, right? It's been the white papers from 2008. So it's, we're moving at this breakneck speed, but like, what do we really have to show for it? Right. It's just, to me, the utility value of, let's just say, Bitcoin, right? What it's being used for is nothing. It's virtually nothing, right?
Someone mentioned to me they saw, and this is more on the Ethereum side, but DeFi is, for better or worse, a sandbox for financial innovation, right? And that people are saying, right, a lot of stuff that like you would in traditional markets need ISDA to trade, like dividend swaps or something like that. Great. Someone decided that if you're a liquidity provider into a decentralized liquidity pool and you have that token, which is supposed to give you sort of pay dividends type things in theory, well, they actually have now found a way to split that into two tokens. And they're recreating all the financial derivatives with none of the regulation around it. And for better and worse, right? I don't think everyone should necessarily be trading this stuff, but I find it very fascinating that this truly decentralized financial platform is being constructed in a way that gives the everyday person access to what institutions only had access to before.
Yeah, it's fascinating. Corey, this has been like pretty, just an absolute fascinating interview, and time is flying by. I want to just kind of switch gears on you again and maybe hit you with maybe some more, a little lighter topic questions here. So when you're not investing, I'm just curious, how do you spend your time, and do you see any investing parallels to it?
How do I spend my time? I am a big gym goer. I'm a gym rat. Other thing, I mean, right now I'm living on Cayman Island, so a lot of my free time is spent going to the beach, or going to dinner with my wife, or going out on a boat. So it's like a very luxury lifestyle at the moment. Fortunately, won't last forever. But that's pretty much how I spend a lot of my time. I would say I think a lot of like the biggest parallels I see in my life as it relates to like investing would be just the gym, right? I mean, I think when you look at what does it take to be successful in investing, it takes sort of that concentrated repeat effort over time, not doing things to injure yourself or take yourself out of the game, not focusing too much on the day-to-day, but having that compound plan over the long run. And then so you can look back 5 years and go, wow, I really made progress, even though day-to-day it didn't feel like I was making progress. I think there's so many similarities there. So
That's
much
fascinating.
that's important to investing that happens outside of actually investing, right? Like when we talk about individuals being successful, what's your savings rate? What's your spending rate when it comes to financial planning? Just like going to the gym, what's your diet like? What's your sleep like? All that sort of stuff. So I think there's a lot of parallels there. But I do try to say when I'm away from markets, I try to just tune out and, I don't want them to overwhelm my whole life.
Yeah, there's a lot to be said there. I mean, again, even on the lifting side, you can't, from a return perspective, you're not going in there and just power lift your first day, right? You need to build up over time. And even from, days off, right? You even need to, from a trading perspective, there's good, from a timing lock perspective, right? There are good times to trade and bad times to trade.
Right, exactly.
That's super fascinating. Another question that I've just been dying to ask you, why pirates? Why the pirate theme? And, do you have a favorite one?
Yeah, so I was, let's see, where'd the pirate theme come from? I don't know. I think it was one of the ones when I was really young. People always asked me what I was going to be when I grew up. And I think I always used to say a pirate or a businessman. And my mom said, well, I guess going into finance, you really did the pirate thing. So I don't know. I guess as a young kid, I always liked pirates. Now living, so Jason and I started this YouTube show just for fun to explore more casually things in finance that caught our interest. And it started when I was living here in Cayman. And so just living in the Caribbean, I was like, well, let's call it Pirates of something. And Pirates of Finance was a fun play on Pirates of Penzance. So I think the whole pirates theme for us is just like, we're sort of, and by the way, I should mention Jason, who does the show with me, owns a firm called Mutiny, and it has a very piratey based logo. So it all sort of mixed well together. And I think just for me, the pirate theme of that like independent spirit, not answering to anyone, is sort of the theme of the show, which is like, we're unapologetically just having fun, exploring, not taking our lives too seriously, which I think sometimes finance can be a little stuffy.
Yeah, that's great. And just my last question for you. I apologize. We teased people in part one about the gingerbread house. Corey, what is a gingerbread house, and do you have any designs do you have any preliminary designs for today? I don't know if you can even divulge it, if it's top secret or not.
Well, the good news is my family won't listen to this, so I can probably divulge it. My family's been making gingerbread houses together forever. It started something as a tradition when we were very, very young. The day after Thanksgiving, we would sit down and make gingerbread houses. And the treat was, we made them in the morning. And as kids, we were just eating way too much candy as we made the houses. And they looked awful. We were just like throwing candy at them. As we got older, the candy turned to booze. And we'd all sit around and make houses, but it also got like a lot more competitive, and not competitive in like, let's make a traditional gingerbread house. It was like, who can make the most out there creative house? And then as we got married, our spouses got involved. So my wife is way more creative and talented artistically than I am. So I mostly just defer to what she wants to do. And then I'm like, she tells me like, okay, go cut the pretzel sticks and all this sort of stuff. But we've had in the past, like, I think the one that really stands out to me was my sister and her husband actually made this Cthulhian monster coming out of the water. They used food coloring to make the house green, and they had these tentacles made out of marshmallows, and the whole bottom was like blue water. So it's really fun. My nephew is now old enough to do it as well. He'll be 3 next year, and obviously it's devolved back into the original purpose of the gingerbread houses of just throwing candy at them. But it's a lot of fun to just have the tradition in the family. And I don't know how it's survived 35 years, but we're still doing it.
I love that tradition. I actually may borrow that for my own family. So
please do.
I think it's awesome. With that, just want to thank you for coming on the show. Everyone, thank you for tuning in. If you did not see part one of my interview with Corey, please check that out. It was fascinating. Just lays kind of all the context here for part two. I think we covered a lot of interesting ground here. Corey, thank you so much for coming on the show.
My pleasure, Seth.
You want to tell people where they can follow you?
Yeah, and before I do, just thank you so much for having me. It's been a real joy. We don't get to connect enough, so I'm glad we were able to make this happen. If people want to find me, they can get our research at our website, thinknewfound.com. You can find my podcast, Flirting with Models, on every major podcast provider. YouTube is Pirates of Finance, and then you can follow me on Twitter at Hoffstein.
Yeah, everyone, I recommend Corey's work very highly. I follow him on all those media channels for what that's worth. Also, everyone, thank you so much. If we had anyone use the super chat and ask questions, thank you so much. Corey will answer those for us, and I will definitely get back to you with those answers. So thank you so much, everyone. Thank you, Corey, and everyone. Have a great weekend as always.
Thanks, Seth.